Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Well, hello and welcome to Private Banking Strategies Podcast with Vance Lowe and Seth Hicks. Vance, how are you?
I'm doing fantastic today. Today is a great day to talk about some more financial matters on how money works.
Absolutely.
And maybe expose a few fallacies that people believe in is actually hurting them instead of making them feel better.
Right. And we've been talking about the private family bank and creating a 100-year family bank in prior podcasts. And we highlighted in the last episode some of the traditional financial planning where it falls short and some of our thoughts on that. And you have some specific expertise and knowledge actually coming out of the traditional financial wealth management world. And you actually did that successfully in the Dallas-Fort Worth Metroplex for a couple decades before discovering a better mousetrap.
We were very successful in what we did during the historic loss years, 2008, 2012. We didn't lose even 50% of what the losses were. But you know what? And I told this to you, Seth, and to other clients. How do you think someone would feel if you spent a career thinking you're doing everything you possibly can for your clients? And then to read a book, actually a client gave me a book to read, and to discover that everything you were doing was wrong and not the right thing to be doing any of the time for clients. It's a lifestyle change. But you know what? As we dug into it, we were in a position to understand and pick up really good, sound money that we could pass on to agents. So we're going to talk about traditional financial planning.
Let's take a 30,000 foot overview of traditional financial planning and what that typically entails and where does it fall short, just from a high level.
On a high level, what you try to do is you establish risk tolerance with your clients. They have, depending on age and structure, they have a tolerance that they want to be involved in. And it's our job to take their excess money and what we thought at the time was put it to work for them in a portfolio. And so we would put a portfolio of all kinds of different things, stock portfolios, mutual fund portfolios. We would even go into things like variable annuities, laddering, all kinds of different sophisticated stuff to meet the needs of the client, depending on when they came in, what their goals and their strategy was, and what the time frame was, is what dictated what we could provide for them. Well, then you have the government issue. The government only allows you to present certain things to certain clients. There are what's called qualified clients and non-qualified clients. We all should find out in government's eyes what they think we are as individuals, and I think it would surprise us. But there were certain things we could show, there's certain things we couldn't, but we would design these things and we would actually use portfolio money managers to look after that and make the trade, especially when we were talking about variable annuities. There's so many choices in those. We would do that on a mutual fund or a stock portfolio. We would either do that ourselves, or in some cases, if a person was more aggressive or less aggressive, we would hire institutional money managers to manage those things. The whole thing was risk, though. It was all about risk. And thinking that we were putting our people's money to work, when in fact, in the financial planning world, we don't. It's just the opposite. We put our money to sleep. The money has to be in those accounts to earn anything. We don't have access to it. We don't get to use it. Many times, if we're talking about qualified, ERISA, government-owned trusts, 401ks, Roths, IRAs, SEPs, all kinds of different tax-qualified trusts, that totally ties up the funds according to the regulations that government sets and is retroactive whenever they change their minds. And that's what we dealt with at the time. And we were still quite successful, we thought. But in comparison, 20 years later, from doing that to what we're doing now, all of our clients would have more than doubled, probably more than quadrupled their assets that actually grew under their own control in private banking than they do putting their money to sleep in financial planning.
Right.
That's a high level look. So
I think also one of the things that we continually run into with folks is even if they believe in market risk and equities and stocks and bonds and the types of traditional financial instruments we just talked about, although they may say we're thinking long term, they're really thinking short term. Let me give you an example of what I mean. Properly structured whole life insurance contracts with the companies that we use are going to grow and compound 4 to 7% annualized tax-free growth or more. Okay. And so when you present that to someone who's saying, oh, well, this financial advisor, he did 30% last year in equities, or, he did 25% over the past 3 years. We talk about that and the comparison of yield versus return and the fallacies that financial wealth advisors sometimes manipulate data with. But bottom line is that historically the life insurance growth and expansion in that tax-free economy outperforms the volatility of market risk and overall, let's call it a 30-year curve, let alone a 100-year curve. If you're going to take it out that far, the life insurance far surpasses the other so-called traditional financial instruments.
it really has. Since everybody looks at the stock market, for instance, life insurance has been around far before the stock market. And it's the philosophy of the grass is greener on the other side of the fence. A bell and a whistle versus the mundane I'm already used to, thinking that the bell and whistle will be better, the short term versus the long term. It's just human nature to always want to go to the new craze, the new popular thing that's out there. And they pass up a huge structure. You mentioned something earlier, Seth, that I want to bring to bear for people. Don't get caught up in performance reports with mutual funds, stocks, bonds, even in the variable annuities. They all report X returns. These are average rates of return. Average rates of return do not relate to what people actually receive. That's a different term. That's called yield. Yield is a banking term. Money put in the account that can never be reversed because of a bad year or this or that. Any product that will penalize somebody for returns puts risk in the system. Yield does not do that at all. So long term, yeah, you're talking 10 years, 100-year legacies, multi-generational. If you really want the growth in that, you can't do it short term. It cannot be done. You can get maybe lucky short term and pull some winnings out. But if you don't have a long-term structure, a structure to get you where you want to go, it's never going to happen. It's never happened in our financial career, which has been a long time now. So people need to understand that the existing financial planning out there today has not changed for decades. Most of them are taught what to say, how to do it when they do due diligence on their mutual funds or their investments. They're told how to say it, what to do, but it still doesn't relate to the financial security that a person thinks he's hearing or she's hearing. So learn the difference, folks. Understand what money really is. Understand and learn how money really works, because that's power that gives you and puts you in control instead of someone else. You don't have to be sophisticated. You don't have to hire what's called financial gurus out there. You can do and reach the goals and results very simplistic, all by yourself. but you need to understand how money works. If you understand how money works, you'll understand how to get it to grow.
Right. Let's drill down a little bit on some of the structural failures of traditional financial planning. One of the things that you've highlighted before is that there's really no unified, uniform system and strategy working on all cogs and pistons firing efficiently. Traditional financial planning generally offers different products and not a system. So you've got retirement accounts and 401ks, brokerage accounts, IRAs, annuities, like you said, term life sometimes, as our friend likes to say erroneously, buy term, invest the rest, Dave Ramsey, who's couldn't be more wrong. But that type of planning, that general planning that we're talking about, is isolated in silos, doesn't work together. It wasn't designed to connect or coordinate or support one another. Whereas with the system of properly structured whole life insurance, we've got a confluent focused strategy where there's one similar synchronicity. There's a single unified strategy that compounds all in a tax-free economy. That's what we're saying will effectively outperform any other type of financial instrument over the long term, and also create a lot less stress and a lot less need for expertise.
Seth, one of the things people need to realize if they switch to self-banking or putting the banking equation back in their life, they eliminate all risk except themselves.
Right.
There is no risk out there. So this is the safest thing I've ever seen on this planet. It's where banks put their safe money. It's everything that could be beneficial.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue, but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Seth, I think you said that we did a podcast one time, and I think it's in our portfolio somewhere, the perfect investment. What does the perfect investment look like?
Right.
It's these old banking contracts that still exist. So in the traditional financial planning, they have to scatter things around because it's called not putting all your eggs in one basket. So you've got to go one area and then maybe move some over in another area, some over in a more secure area. The risks are not accurate. There's low risk, there's medium risk, and there's high risk. Well, in the high risk category is where all the money is. This is where people salivate and say, wow, I want those type of earnings, but I want the lowest risk possible. So the market got smart. They took the high risk and divided it into three: the low, the medium, and the high. So the high is way out there. Okay. The medium is still high risk and the low is still in the high risk category. But because they split that out, you're in the low risk thing. You think you're in a low risk portfolio and you're not at all. So that's important for you to understand. Many investments are highly susceptible to markets and economies. Just look, every day you get to hear, the Dow went up or the S&P 500 went down or this went up and down, and everybody sets their watch to that. Bankers don't. Mortgage companies don't. Mortgage companies have their own philosophy of why their interest rates go up and down, and it's not the reason everybody thinks. It's not based on economy. It's based on greed. And so all these factors play into financial planning. Like I said, the reason I really loved it is because every single family, every single financial plan was completely independent, all by its own. You have to take into so many different factors. And it was great and fun to work out the structure. And then to manage that and manage those assets for a gain was very rewarding. There's one more thing in financial planning, and that's where the financial planners and the money managers get paid. See, they're going to get paid either way, whether you make money or lose money. There were contracts out there where you only paid the money manager if you made money. If you lost money, you didn't have to pay his bill. Well, government kind of, I don't know if that's still available now or not, but it was pretty much completely gone before I left. And stockbrokers, they have had to put in churning laws years ago because stockbrokers would get you in one and then move you to another one and move you to another one. And there's a fee involved, both on the sell and on the buy. And a broker could literally break you, spend all of your money making trades for you. And he ends up with all the money. So they had to put laws in to stop that, but only to a point. And on the day that that time frame is up, you're going to get switched into a different account. Same thing with variable annuities. They usually have surrender penalty periods. There are some that don't, and those are not very well sold because the commission and the income off of an annuity isn't very high if there's no surrender penalty period. But you better believe on the day that that surrender penalty is over, you're going to get, pitched a new annuity or a new something else because they want more money. We don't have to deal with that here. You are doing everything you want to do outside in a private family banking strategy than you could ever do inside a financial planning portfolio where someone else has all your money. You never lose control in the banking side versus the financial planning side. You have no control.
And one of the things that always jumps out to me that people will sacrifice for their so-called security with traditional financial planning is that they'll sacrifice their liquidity, and their money becomes so locked down that it's really just a mental position that has a false sense of hope and reality.
Yeah, that's, either being liquid or non-liquid, right? Either working for you or not working for you. If it's non-liquid, it is not working for you. It's working for the people who have the money. Those people are doubling your money on the average of every 5 years, per se, okay? Where you are getting as low as interest as they can get away with in your accounts, if anything. Okay. You, though, take all the risk, not them. Oh, we didn't make enough money to pay you. We were able to pay ourselves, but we don't have enough to pay you, or we're only going to pay you 1%, which isn't even the cost of inflation. You have no control over that because they are using your money. What if you got to use the money without any risk and could still double it just like they do? And we'll say every 5 years. That's the difference we're talking about here.
So we've highlighted this before, but it bears repetition with traditional 401k and other government sponsored programs. You've got forced imprisonment of your money. You've got early withdrawal penalties. You've always got taxes on the gains and the distributions. You've got forced distributions, and you've got a constant dependence on money in the psychological sense that you can't access.
Well, see, in the private world, you control all of your assets. You store your money in a place that is not affected by ups and downs. It only goes up. You have access to that money whenever you need to. In the market, all the economist has to do is just come on and make an announcement and it'll tank the market. Something could break out, something could go bad, a war could happen, import problems could happen, and it will affect the market. So if you have market risk, you're going to feel that. And you made a statement that I feel like a lot of people rely and always think the market is going up. That's a fallacy. Our market would have crashed years ago had they not put in as much as $1 billion per day. Our government soaked into the market for years, much money in order to keep the market from crashing. So where the market is today, whether the government pulls that money out or what they do with it could definitely affect what's going on in the stock market. It's not all what we see. Rates of return, average rates of return. I give an example all the time of managing $100,000 for 4 years, doubling it, losing half, growing it by 25%, losing it by 12.5%. And we ask, if you could do your math, how much money would be in the account? Virtually $100,000. But the prospectus and the math shows a 25% average rate of return over that 4-year period of time. If that was correct, there should be somewhere around $250,000 to $300,000 in that account instead of 100. So what went wrong? Well, nothing went wrong. It was the math, but it had nothing to do with what an individual makes in an investment. In the banking, everything is yield. It's your money, okay? Everything. You even know future. There's part of the banking, which are the profits of the bank. Life insurance carriers have never lost money that we deal with, because that's one of the qualifications that we use. And we're talking 100+ years. Through all these financial issues that our country has faced, they've always paid out profits. So in addition to the guarantees, they pay out profits. Profits, I can tell you, for 2025 and 2026 are somewhere between 5.5% and 7%, paid directly into accounts on mature contracts, plus the guarantees. Long term, you mentioned lifetime. Since the stock market has been in, life insurance has outpaced and outgained the stock market long term, I think, any 10-year period of time. I haven't done that in recent 10 years because the market's been manipulated, and I don't trust these numbers currently anyway. Because when government gets in and interferes, it still means nothing to what people make. So I think those are some, I guess we drill down a little bit, it's still high level comparisons between banking and financial planning. Financial planning, you have to rely on someone else's expertise. Banking, you rely on your own expertise because it's simple.
Well, I think that that's part of the verifiable contrast between the two different systems. And you talked about a money insertion of $1 billion a day into the market, and people go, how do you prove that? Well, look at the national debt calculator over the last 25 years. And there's just been this massive money supply insertion into the economy. And it's the fundamental flaw in the concept that you can print more money and somehow prosper ultimately and financially. And that's a flawed economic model. And
let me tell them what that is. There's the Keynesian economic, which we are under, which states you can create more money as you go. But the banking strategy is under Austrian economics. So there's a finite number of dollars, and that value grows on demand. So those are the two different. When you're under Keynesian, this guy, you got to know his history. And I don't know why it's been adopted and stays. It's because of corruption. The only reason Keynesian economics still exists in countries like ours is because of greed and crime.
Yeah, that's the ultimate policy behind those two different competing strategies. And you're right. Unfortunately, they've spent their way into oblivion and printed money into oblivion, and now have a compounding national debt that is almost insurmountable. And so that's another highlighted contrast between the private banking strategies versus the traditional financial planning, is with the attrition of your earning power. And one of the financial planning flaws is tax inefficiency. Let's talk about taxable gains and required minimum distributions. Or how about this absurdity, Vance? Tax on Social Security benefits. Is that not ridiculous? But it's disguised.
Yeah, and we put up with it. Folks, government has no power unless we give it to them. But if we're ignorant and we don't understand the system, then we have to rely on somebody. And we're giving our freedoms away every single day.
Yeah, those are some great points, Vance. At this time, folks, I think we're going to transition into our book offer to you. If this information is resonating with you, if it's intriguing, Vance and I have authored a book called What the Banks Don't Want You to Know, Secrets the Banks Don't Want You to Know, that will help you create wealth for your family. And that book is available to you in a PDF version or an audio version to listen to on the go on our website, privatebankingstrategies.com. So at privatebankingstrategies.com, you'll find that book offer, folks. And also you'll find a tremendous amount of resources that we have compiled to educate you, our audience. In the resources tab, we've got over 150 podcasts. We've got article after article explaining concepts. And so we hope that you'll dig in there. And if that content resonates with you, and if you want to learn more, in the emails that we send you, there'll be an opportunity for you to schedule a call with Vance, an exploratory call with Vance, and learn how private banking strategies can work for you, and actually dig in to how you will actually apply it. And that's in a multi-layered meeting process, but we like to call it the 8-year analysis. That 8-year analysis will help you walk through every decision that you can make for your family in that 8-year period. Vance, any closing remarks?
No, it's like coming to the end of a dark tunnel and just always walking out in the light. It's a breath of fresh air. It's absolutely fun because everything here, it just resonates. It's just truth. It's just, wow, this rings. This is right. No stretch of an imagination or anything. So again, thanks for listening. Really appreciate it.
Absolutely. Thanks for joining us, folks. We look forward to seeing you on the next podcast. And until then, thank you from Private Banking Strategies.
Bye-bye.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies podcast. Click the subscribe button below to be notified when new episodes become available.